Myself, Lydia Jemima, Assistant Professor, Department of Commerce, Kristu Jayanti College, Autonomous. So today we will be moving on to the Module 2, Module 1, Part 2 of it, wherein we're going to discuss about the key concepts, financial terms that is there in the company's context. So we were looking on to previous concepts that we were talking about, the basics of the balance sheet, income statement, cash flow statement. We're talking about few terms that is used in companies which we will come across. Okay, so the first one is depreciation. So I think most of us would be knowing about this depreciation. So when you buy a land, right, so you would have purchased a land for some amount. During the course of years, you know that the value keeps going down, right? The asset value keeps going down. So that is what it is called as depreciation. So that is, depreciation spreads out the cost of a tangible asset over its useful life. So when you, tangible asset, what is this tangible asset? Anything that can be seen and touched, right? Tangible, visible to you. Now when you are owning a bakery, right, you can see that the oven, that is the visible machinery or equipment that is helping you to mix up all the ingredients in it, right? So in that, if you see, you would be able to know that the value of that particular machinery keeps going down, right? It becomes outdated. So the purpose of depreciation is it reflects the asset's decreasing value over the time. Okay, so accrual basis accounting. What is this accrual basis of accounting? So it records revenues and expenses when they are earned, whether they are earned or incurred, regardless of when the cash is received or paid. Okay, so even it is noted down, accrual basis, that is regular basis accounting. Whether that particular cash is received or not, you will note it down, right? So it records the revenues and expenses when they are earned or incurred, regardless of when the cash is received or paid. So what is the benefit of it is it provides more accurate picture of company's financial status, because you are recording everything that is happening, right? So example. So again, we're coming back to the same example of you are owner of a bakery. Now when you see depreciation, you buy an oven for $5,000 and expect it to last for 5 years. You expect that lifespan of that particular oven, it will give you a good yield for 5 years. And your expense is $5,000 each year. So that means the value of that particular product is coming down, right? You're having an expense of $1,000 every year. Now imagine you have bought that for just $5,000. So the value has gone down, right? Now when you go to the accrual basis accounting, you record sales. That is, you're selling the cakes or pastries or anything, not when the customer pays. Probably some would have purchased it and gone and asked to pay it later, right? They would have taken for loan, right? They would have told that we'll buy it and go and later we will pay it to you, right? That is the accrual basis of accounting. You record sales when you sell the cakes, not when the customer pays. Okay. Now the next term which we will be talking about is GAAP, that is generally accepted accounting principles. So what is this GAAP? GAAP is a standard guidelines for preparing and presenting financial statement. Here, US countries follow this GAAP because they only formulated it, and here they have set of rules and regulations. Okay, they have to use it while preparing their financial statement. You need to abide by the rules and regulations that is given. So what is the importance of this GAAP? It ensures that financial statements are consistent, comparable and transparent, right? When you prepare according to GAAP, you will be able to compare. You have a consistent method to follow. If you have your own way of preparing your statements, financial statements, it can be balance sheet, income statement, cash flow statement, then it is going to be a very tedious task for the companies to compare with the other companies how well you are running, if you have your own way of maintaining the accounts. Now it is always suggested, or it is a mandatory rule, that your accounts should be as per the guidelines given by GAAP, right? So application, it is used by US companies, okay, to maintain uniformity in financial reporting. Okay, we have something called as Ind AS, right? Indian Accounting Standards. That's what we follow, right? And think GAAP as a recipe book for accounting. Just like how a recipe ensures your cake turns out the same every time, GAAP ensures all companies follow the same rules so that financial reports are reliable and comparable. So we are again bringing this with the example of a bakery, right? You need to keep this GAAP as your recipe book, right, for your accounting, just like how your recipe ensures that cakes would turn out very good. If you miss even one ingredient, then it's gonna be a chaos, right? So we have the next term, that is cost of goods sold and profit margin. What is this cost of goods sold? Direct cost of producing goods or services sold by the companies. Cost of goods sold is your direct cost that is involved, that is there in your when you have a sale, right? What for selling a goods, what are the expenses you are incurring, or the cost that you're incurring? Probably to materials you procure to manufacture a particular product, labor, that is the labor workforce, and the overhead costs, right? And profit margin, it measures how much profit is made from each dollar of revenue. Calculation, how it is done, net income divided by revenue into 100. That gives you a profit margin percentage. Now your net income, you get it out of minusing your revenues and expenses, total revenues and expenses. You divide it with your total revenue and you would be getting your profit margin. So direct cost of producing goods and services sold by the company is your cost of goods sold. Okay, components includes material, labor and overhead cost. Example for your bakery, again here, cost of goods sold can be cost of flour, sugar, wages for baking. That is your cost of goods sold. Okay, profit margin is you would have made $5,000 in sales, and now you and 2,200 rupees profit. Now your profit margin would be, with the help of the formula, okay, that is net income divided by revenue into 100. How is that calculated? So you're making a net profit of 2,200 divided by your sales into 100. That gives you the profit margin. That is you are having a 44% of growth in your profit. Okay. Next concept that we will be talking about is, I'm just going to give the introductory part to the double entry accounting system. You know that every double entry means there's something called as double, something two is there. That is nothing but you have two heads, that is debit and credit. Okay, you will enter the details in your debit and credit based on your incomes or expenses. So double entry system, it is recorded on the left side of an account, that is debit. Debit is always on the left side of the account. And what is the effect of this debit side? It increases the assets and expenses and decreases in liabilities and equity. So when you have an increase in asset and expenses, that is when you buy something, when you procure a machinery, or when your asset, all your assets, right, your cash and everything comes in a debit side, okay, left side of the account. And all the decrease, when you have a decrease in your liability and equity, when your liabilities are reduced, when you make payment, right, your expenses, everything comes to the debits. What is this credit? It is recorded on the right side of the account. What is the effect of this? It increases liabilities and equities and decreases assets and expenses. So example, when you pay rupees 500 to owe a flour. Okay, debit accounts payable, that is decreases by 500, reducing your debt because you are paying 500 to own a flour. And credit cash decrease by 500 because your cash is reducing here, right? So what are we recording here? So here we are recording increase in liabilities and equity, decrease in assets and expenses. What is your asset here? Your cash. So you're buying a flour for rupees 500, your cash is reducing, that will come in credit side. And what is your expense here? 500 is the accounts payable, that is your expenses, that comes to your debit side. Thank you.